as the price of silver, especially, rose rapidly, a lot of people entered the market using CFDs, that's contracts for difference, which obviously lay off their risk in COMEX and other places like that. But when you use CFDs, you typically have a 10-to-1 leverage ratio. You can use more or less depending on where you do the business, which means that the CFD provider, this would apply also to people trading futures, but in a slightly different way. The CFD provider is going to put in place an automatic stop loss, whether you like it or not. That stop loss might be adjusted according to how leveraged you are, to how much money you've got in the account, and other factors. But in general, when people are trading CFDs, they're trading on a leverage basis. And we had people all around the world doing that. And ultimately, those risks are laid off via COMEX and other places with what's called stop losses. Stop losses are trigger points, price levels, at which a position will be automatically closed. And if we're talking about someone who's long, closed means they sell their position if the price goes below a certain level. And the reason the CFD companies or betting companies do this is to make sure they never get into a situation of a loss. So as the price starts to decline a little bit towards the level where the CFD company could lose money, or on COMEX where the broker could lose money because his client has got a position, they will say either to the client, stump up more money, and and typically you have to stump it up immediately to make sure you're covered for after the price decline, or more likely, especially in the case of the contract for different sites, it's a stop loss, which is a hard one, which will be automatically triggered at, let's say, 5 or 7% away from the. Let's say you've got 7% running, and the price has gone down by a couple of percent. You're immediately getting too close to the point where you're losing money, and it'll automatically trigger the stop loss. So each stop loss, as it's triggered, causes an instant sale. Now, that sale doesn't automatically happen at the stop loss price. It happens at the next price traded after the stop loss has been touched by somebody else. Now, in a normal market, that often means you get the stop loss price because there's an army of people willing to sell at a certain price. So the first one sells at the stop loss price, but there's an army of people willing to buy at the stop loss. So it touches that, but you can come in second, third, fourth and get the stop loss price too. But in a fast moving market, especially the one we've seen, there won't be so many buyers sitting there to absorb your order. So when your order goes through, someone touches, let's say $110, which was your stop loss, your next trade, you'll get the next trade, which might not be at $110. It might be $109.95. But of course, there's going to be another person with a stop loss at $109.95. So his stop loss gets triggered and he gets traded at, let's say, $109.85. And guess what? There's another person behind that with a stop loss of $109.85. And so it goes off. So we then have this cascading series of stop losses, each one creating a sale, driving the price a little bit lower, which then triggers the next one below, and so on. And of course, there would have been millions of these stop losses sitting around in different places all around the world. And obviously, a lot of people got the money they had in their CFD accounts effectively mostly wiped out by that fall.
Government officials are claiming the economy added 50,000 new jobs, but the reality looks very different. In fact, employment is down by around 900,000 since December. At the same time, the population has risen by roughly 5.6 million. Instead of admitting weakness, they revise older numbers downward, creating the illusion of growth. That's why many wealthy investors aren't buying gold to make money anymore. They're buying it as insurance. Debt is spiraling, pressure is building, and people can feel that something is coming. The recent silver crash wasn't necessarily manipulation in the classic sense. It looked more like a chain reaction, stop losses being triggered one after another like falling dominoes. That's what happens in a fragile market. One sharp move sets off the next, and suddenly the selling becomes a cascade. And the bigger message is this: physical metal isn't meant for short-term trading. It's meant for survival. Because when the system is rigged, paper promises don't protect you. This entire move really accelerated after the announcement that Kevin Walsh had been appointed as the next chairman of the Federal Reserve, set to replace Jerome Powell when he retires in May. The appointment surprised many people because when investors looked into Walsh's background, they found someone known for strongly defending the Federal Reserve's independence and someone who likely wouldn't support aggressive quantitative easing. That impression came from his time as a Fed board member back in 2011. Whether he truly governs that way or not, the market treated his appointment like a spark, and that's the best way to describe it. Are you curious about investing in gold and silver, but feel held back by fear or confusion? This ebook is designed especially for new investors who want clarity, not complexity. It breaks down gold and silver trading strategies in a simple, practical way. No jargon, no hype. Why wait? Hurry up. Please visit this link to get your copy today and use code MRJGZBYA for a huge discount. More than 1,000 people took the first step with this ebook, and today they're living proof that smart investing changes lives. Now, this book is also available in Amazon Kindle. Go and hurry up. The economy right now is like a forest full of dry wood. The conditions have been building for years, getting drier and more unstable over time. You never know exactly when it will catch fire, but once a spark hits, the flames spread fast. Walsh's appointment was that spark. But the real reason the fire spread is because the system was already under extreme stress. Now, the next phase for silver is likely a period of consolidation. It may trade inside a range, bouncing between a top and bottom band for some time, but eventually it will break out. And when it breaks out, it will likely move hard in one direction. If it breaks down, silver could fall much lower, maybe even toward $50. That's not a certainty, just a rough estimate. But if it breaks upward, the upside could be dramatic. Silver could be heading toward $150, maybe even $200, driven by a supply-demand imbalance, rising geopolitical risk, and growing uncertainty across the world. The demand story isn't just industrial anymore. Yes, industrial users will keep buying silver because they need it. But the second wave is investor demand. More and more people are starting to think, let me at least buy a few silver coins just to get started. That kind of steady grassroots demand adds pressure over time, especially in a market where physical supply is already tight. And that's why the argument is simple. If you're going to buy silver, buy the physical metal. Not because you want to flip it next week, but because you want something permanent, something you can hold forever. A parachute, an emergency fund, something that stores value long-term, and most importantly, something you can access without needing permission from a bank, a broker, or any institution. That's what physical metal is: independence. Do like, share, comment, and subscribe to this channel. Also, don't forget to hit the bell icon for more updates.